John Dunleavy, Monorail. How to build a recession-proof portfolio. One of the key ways that you can mitigate risk in an equity portfolio is through diversification. And during periods of ugliness, I think that one good example is to increase your allocation to fixed income. The last time we had a very ugly period where we had negative stocks and negative bonds was 2022. The difference between now and then was during 2022 was the period after the pandemic where the Fed was pursuing a zero interest rate policy. So coupons on bonds were quite low, actually less than 1% on a lot of the yield curve. If you think about the formula, right, for total return for bonds, interest income plus price change. So you had minimal coupon income or carry. The reason we had negative returns during 2022 is that it was a big price change. Contrast that to right now, where we have coupons across the yield curve of in the 4% range, is that provides a buffer that we didn't have in 2022. So even if you're in the camp that we're going to have negative equity returns this year, owning more Treasury bonds should help, because that 4% carry will help offset the negative impact. And as I expect, more people will come into the bond market as a diversification tool, which will prop up bond prices. So that's one way. Another way, we have elderly clients who have limited nest eggs. So we believe on SWAN investments here, which are sleep well at night, SWAN. And people like that with limited nest eggs and elderly, and we have to allow them to, if they have a limited tolerance for risk, to alter their portfolio either into cash or more bonds or however they want to position themselves. But for everyone else that has the ability to wait out the storm, that historically has been the best way. And already, since all this whole tariff-induced trade-off occurred, which mostly happened during April, since that happened, we've recovered most of the downfall already. And as of today, we are only down 4% or so on the S&P 500. But I think the bigger challenge is not so much recession, but stagflation, which is the bigger devil, I guess, in that, because the Fed really doesn't know how to fight stagflation. The problem with stagflation is if it's just a recession, the Fed knows what to do. They cut rates, stimulate the economy, and that's the way they fight it. If inflation's a problem, they know they raise rates and slow the economy, and that really slows inflation. And the biggest example of that strategy was Volcker during the 1980s, when he boosted interest rates all the way up to 20% to kill inflation. And I think that that's Chair Powell now seems to be indicating he wants to be more known as a Volcker than as a Burns. Burns was the guy that started the whole problem with inflation during the Carter administration. So that's another way of stagflation. And the problem with stagflation is, as I said, the Fed doesn't know what to do. If you get slow growth and you get high inflation at the same time. An analogy, I think, is when my wife used to trust me watching both of my boys, and analogy is if one boy runs in one direction and one in the other direction, what do you do? And this is kind of the dilemma the Fed's in, where you go one way, you go the other way, you stay in the middle and you hope they come back. The Fed doesn't really know how to fight stagflation, so they have a tough decision to make. But I'm not saying we're in the stagflation camp. I'm just saying if you're worried about downside, the bigger downside potentially would be stagflation rather than recession, because recession is more of a common cold for the Fed. They know how to fight it, and it's usually effective.